Okay, welcome back. Nishal Maheshwari is still with us of Centrum Broking. Nishal, thanks for waiting. So let's just talk about banks, if you will. And stocks have corrected quite a bit on the back of what has happened on the Adani Group, shares declining. Numbers continue to come in pretty solid. Today we'll get numbers from State Bank of India where expectations are running pretty high. What's your sense? Are these at least the top tier ones from the PSU bank space and even from the private bank space good buys at current levels?
So I think the correction has happened ahead. Basically, I was expecting this to happen maybe in the fourth quarter when the margins actually peak out. And then the thing happened. But I think it has happened ahead of the time. And I think it is a good time, actually, some of the banks, basically. And if you look at it, the exposure are not huge compared to the balance sheet size, even if anything goes bad out there. And I don't believe at the moment there is any reason for us to believe that something is amiss out there. So I think these are all good prices. SBI, ICICI, Axis, all the three have corrected basically. I think they're good entry points for people to come in.
Okay. Now, one more space I want your views on is life insurance, stocks which have fallen quite a bit. We've got some encouraging kind of commentary from the SBI Life Management. That was a favorite, coming into this year as one of the life insurance stocks which is poised to do well. Again, there has been a fair bit of damage. Not so much in SBI Life, it's been more in HDFC Life and Max, etc. But anything you like in that space?
So our favorite has remained to be HDFC Life in that space. Basically, we are just assessing, saying that how much more, basically, because even in case of ULIP below 5 lakhs, there used to be a substantial amount, basically, which used to be there across the industry. So when insurance is not going to be used as an investment instrument, how much damage is going to happen over the industry? But I think some of these companies have already made their transition, Max and HDFC Life in particular. They have already made their transition where the ULIPs are pretty low. So our favorite still continues to remain as HDFC Life there.
Okay. All right. Thanks so much, Nishal, for stopping by and discussing all those stocks. Wishing you a good Friday ahead and looking forward to having a chat with you rather soon.
Thank you.
Well, the next stock on our radar is Birlasoft. Remember, yesterday it got a hard knock in trade ahead of its numbers. Now we have the numbers to look at, and also we need to understand what's the impact of Invacare. Remember, they had won a big order from that company and they had filed for bankruptcy. To understand more about that, we're joined by Mr. Anjan Guha, the MD and CEO of Birlasoft. Well, good morning, Mr. Guha. Good to chat with you and congratulations on taking charge of Birlasoft. Well, it appears we have got quite a few aspects to discuss. So let's start off with Invacare first. You had won close to under $240 million order a few years ago. So how much of that is executed and what was the rough quarterly run rate that we were doing from this particular order?
Yeah, so Nigel, first of all, thank you for having me on the show. Invacare was a deal that we won, and as you know, that was about $240 million. Right now, they have filed for bankruptcy. And we got the notice only about 36 hours ago, right? So we are still assessing, what is the future for Invacare contract. And, keeping in mind the good corporate governance, we've at least provided whatever we know we should provide. And that is the way we're going to look forward. But look, for us, please look at our growth outside of Invacare. That's important.
Mr. Guha, before we get to the growth outside of Invacare, we just need some more clarity. First of all, this provision of 151 crores, is this just an interim number right now? Could it go up? And also help us understand, how much revenue had you booked out of that contract? Your sales are quite flat this quarter. Is that because of this Invacare issue?
So, no, that is not because of the Invacare issue. Look, from an Invacare perspective, we typically bill we bill a larger number, but our revenue is roughly about $4 million a quarter. Now, the reason why our revenue was flat is because this quarter was a quarter that had a lot of furloughs, unusual furloughs. And there was a couple of projects that went on hold, and that is the reason why we had a flattish quarter. And it is a seasonally weak quarter. But from an Invacare perspective, look, it's about $4 million worth of revenue every quarter. That is what we take. Right now, the reason we did the provision is because we know from today's perspective, the $19 million of provision that we took is as of today. Now, future, we don't know how the future looks. It all depends upon, we are talking to our lawyers. It all depends upon how the Chapter 11 carries on, and then we will take a call at a later point in time.
All right, Mr. Goa, out of that total 240 million, how much was done? How much is pending?
So, we can't give an exact number for it.
You can give me a rough number.
So, well, it's a 10-year contract, and you know that we've served them for 4 years, so I'm sure you can do the math.
All right, so 240 odd, 240, 10 years, so 24 million, you're going at a run rate of close to around 4 odd, and I think you're only around 5 years into it. So it appears that, close to around 120 odd would be pending and 120 would be, already done. I think that's the rough math. Perfect. Okay, got it. All right, earlier when we had, the management joining on the show, they were always talking about this big aspirational number of $1 billion of revenue by 2025. At current reckoning, I think you're doing close to around 600 million odd per annum. What's the goal since you've taken over? Do you want to revise that guidance?
So, Nigel, we are committed to delivering industry-leading growth. That's all I can tell you at that point in time. The billion-dollar number that we spoke about earlier, that still stands. The timing may change a little bit because, we have to really assess how Invacare goes. But we are committed to that growth. We are committed to investing in our business. We are committed to investing in our frontline, in our capability, and we will build a growth-oriented business.
Mr. Guha, you've come on fairly recently. You've taken charge. Are there any changes you would like to effect, or you think, the direction, etc., was perfectly set, and that's the way to go? It's just about execution. Are there any strategic changes we should expect?
Yeah, so, Prashant, we are doing a couple of things. One is we will transform the company from a culture standpoint. And that's important to me personally, to make a lot of investments in terms of how do we transform the company, not only from a capability, but the leadership as well as from a culture issue. So to me, all the investments that we will continue to do will be in these three areas. From an execution perspective, I think we've done a good job in execution. We will continue to execute well. But like I said, the investments will continue to happen.
Mr. Goha, just a word on margins. Again, we're just trying to understand the business X of Invacare because EBITDA margins obviously dipped to just about 0.5%, just northwards of 0.5%. How should we read through? And what do you see as a sustainable margin rate going forward?
Yeah, so really good question. So, if you really think about it, the Q3 was a quarter which had furloughs. And also we did a lot of investment in terms of building capability, getting in more leadership. And that kind of affected our margins a little bit. I strongly believe 4Q, we will be back on delivering higher margins than 3Q. That I'm confident about. But look, I will continue to do more and more investments in capability, in sales, and all of the stuff that I talked about, including, creating a domain Vinia.
Okay.
So, look, I would say that, we want to deliver from a long-term sustainable perspective of 15% EBITDA margins. That is our goal. But I will also tell you this, that we will continue to invest in the business going forward.
Okay, all right. Final question then, and it's more in terms of hiring. The number of employees, your headcount had declined quarter on quarter. Attrition, though, has come down, I think, to around 25%. What's the outlook on both these two parameters?
So look, attrition, I think we've done a great job in terms of our people engagement, which actually reflects on our attrition. I personally feel the attrition will keep going down, and that'll help in our margin uptick as well. From a people addition perspective, again, you must look at it from an overall perspective. Though we will add people, but equally, look, we are driving a lot of productivity. That obviously helps in the bottom line. So we will continue to do that.
Mr. Goa, it's a pleasure. Thank you very much for your time. And we wish you all the luck to kind of steer the business in the right direction and achieve those aims. That's Birlasoft, a sharp correction yesterday. And this morning, is this morning's rate? The pre-open is, of course, already started. It's down 5%, I think, in the pre-open. Let's have other stocks up as well. I think I saw a big gap up, but that was the initial gap up rates on the Nifty and the Bank
IndusInd
Nifty.
Bank, in fact, Prashant, I mean, Ritu's story, what she's been pointing out, promoters perhaps looking at hiking stake, that one's really catching the attention. In fact, it's leading the Nifty, going by the pre-open, 3% up on IndusInd, and the Nifty itself is looking at a gap up of about 0.6% now.
Yeah, IndusInd actually in the Bank Nifty, it had lost the most in that entire carnage. It was down some 10-11%. It was up 4 yesterday. It's up another 3 today. So that's very quickly adding on. Let's have the Nifty up and let's just quickly look through the Adani stocks as well, at least in the pre-open. There's 5 minutes to go for market open. 100 points, 17,721. That's a reasonable kind of start given the very strong cues from last night out of the US. The important thing is what happens half an hour, 2 hours into the session after we start. The Adani stocks, ports, enterprises, if you can look at Ambuja, those three I think will do it. Ports is starting 0.75% lower. That's pre-open. Enterprises is down 4.8, and you've got Ambuja Cement, which is starting kind of flattish as well. Let's stick with these stocks. I mean, they've been included, the Adani, 3 of these names have been included in the additional surveillance mechanism of the regulator. What does this mean? There is also, of course, that Dow Jones Sustainability Index news which has come through. Vivek is joining in with a quick update on the impact of both these. Vivek, over to you.
That's right. Good morning. So as you rightly mentioned, these 3 names, Adani Enterprises, Adani Ports, Ambuja Cement, remember all of these are also available for trading as far as the derivative segment is concerned. They've been put in the ASM or the additional surveillance measure. What this basically indicates is that as far as intraday trading is concerned, the short-term ASM actually implies that trading will now require traders to give 50% additional margin requirements upfront to go ahead and trade in these particular stocks. So that is precisely what this particular development means as far as these 3 stocks are concerned. Now, interestingly, when you're talking about Ambuja Cement and Adani Ports, both of them are also in the F&O band, which actually indicates that you cannot take fresh derivatives positions as far as these 2 names are concerned. Adani Enterprises will also remain in focus as this particular stock will be removed from the Dow Jones Sustainability Index effective, Tuesday, that is February 7th, 2023. And lastly, some positive news flow also coming in as far as Adani Ports bonds are concerned. Yesterday, Goldman Sachs kept an investor call where they actually were quite positive. They said that the debt prices have hit a floor as far as the near term is concerned, and they believe that the bonds of Adani Ports have become interesting. JP Morgan too, in a credit analysis note, has said that there is now value in debts of some of the Adani Group operating companies.
Okay, got that. Thanks very much, Vivek, for all that important news flow around the Adani Group. We'll keep watching out for those stocks. Let's also put the spotlight on Crompton Consumer. That's another stock that we will watch out for in the mid-cap space. Earnings came through. Rima, do give us some more details.
Thanks so much for that. So Crompton Greaves is a top-down miss. It's disappointing on all parameters. It's fallen short of our expectations. So the revenues this time at 1,516 crore misses our estimates by nearly 150 crore rupees. Margins too fall short of our expectations by nearly 180 basis points. In terms of a year-on-year growth, the top-line growth was just 7%. Margins have fallen from 14.3 to 10%, and profits too are down consequently by 41%. The company indicated that this was a challenging quarter because of subdued consumer demand led by inflation, 2, increased competitive intensity, and 3rd, their pumps division, the pumps business, is facing certain headwinds. Back to you.
Okay, all right. Thanks a lot for that, Rima. And as we speak, in pre-open, the stock is down 6.5%. But the Hinduja Group is looking to hike its stake in IndusInd Bank after the recent revision in RBI's private bank ownership guidelines. Sources have told CNBC-TV18, however, that the promoters would need RBI's explicit permission to do so, which is yet to be sought. Ritu joins us to fill us in with all of those details. Ritu?
That's right. We understand that the Hindujas are in the process of making an application to the RBI to hike their stake in IndusInd Bank to up to 26%. Currently, the Hindujas own about 16.51% as of December, with voting shares at 15.16%. If the RBI does give them this approval, there's a few ways to go about it. One would be to buy additional shares through the open market, but there it would be subject to the overall foreign shareholding cap of 74%, so limited headroom. The other way would be for the bank to issue shares via a QIP or preference shares, but that route we understand is unlikely, at least at this point of time, because IndusInd Bank is not looking to raise equity capital in the near future. So we'll have to see how the promoters proceed, but the first important step would be to secure the RBI nod.
All right, Ritu, thanks very much for that. That's definitely one of the top stocks on our watch list. If the pre-open is something to go by, then it's going to be a decent opening. And the heavies are really batting. There's Reliance, there's TCS, there's L&T, there's ITC, ICICI Bank. So, all of your big boys are right up there. And they seem to be suggesting that the start should be positive. But I think, Prashant, you really said it. The start can be positive. What happens a couple of minutes post and then through the course of the day. Also, as this, the ASM adjustments happen on some of these Adani stocks, the three of them, I think we'll have to watch for that.
Oh, absolutely, Surabhi. And we'll see, what does the sort of the price volatility we've been seeing, wild swings that calms down a little bit. Hopefully, 100 points higher on the Nifty is what we have. 17,718 is where we start. The Sensex starts at about 60,302. These are the initial rates which are starting to come through. Let me just quickly take a look at, straight off the bat, the Adani names and see what's happening. Enterprises is starting about 4.25% lower. That is, of course, part of the Nifty. Ports is absolutely flat. It's down about 1/3%, I think, to begin the day with. Ambuja Cement is the other one, which is down about 1.8%. Ports is now down a full 4% or so. So there is a little bit more in terms of activity on the downside, which is coming up, but nothing like what we've had yesterday or the last couple of sessions as well. So that's right off the bat. Total gas is down. Total gas is 5% lower. And I think transmission is down 10% as well. Those are, of course, cash shares. Green, Adani Green should also come up on your screen. That is down 10%. Still a fair bit of pressure coming through. The Nifty and the Bank Nifty are still higher. The Bank Nifty's got 1.25%. That is what outperformed the Nifty yesterday. So we'll see what happens today. Still a good 100 points, triple-digit gains on the Nifty so far. Surabhi.
Okay, I'm looking at Titan. This seems to be a case where bargain hunters are trying to snap things up. The quarter wasn't that great. We'll be talking to the management in the next couple of minutes as well. But there's buying coming in, perhaps at lower levels. IndusInd continues to be in pole position. Some of the other stocks, let's watch out for the ones on which there is news flow. In terms of the result reactions, Birla Soft has opened down about 7.5%. Crompton, we were discussing with Rima just a while back, again a 3% cut there. GMM Pfaudler, market's not too enthused, so there is a margin expansion, 2.5% down there. Berger Paints is down about 2% as well. I'm trying to see if we have any positive result reactions. E-Clerks is one, and there's some green on Aditya Birla Capital. Otherwise, the mid-cap index, by the way, has already slipped into negative territory. It's flat. Markets holding up about 0.5%. Mid-caps are already feeling the heat. Karnataka Bank is a very interesting mover this morning. Check that one out. 8.5% almost up on Karnataka Bank. In fact, Bank of India, South Indian Bank, a couple of these, Canara, Union Bank. So your mid-cap, tier 2 banks are doing pretty well. But otherwise, the Nifty itself, 0.5%. Mid-cap index already flat, Nigel.
Well, I have preference for the market opening up in the red because it makes it easier. It helps you to get in if you want to get in. When the markets open up with a gain of around 125 points, it makes it even more challenging because how do you chase that sort of a gap up with the kind of news flow that we have? For the time being, we've come up 40 points from the top, so that's a little bit tricky. I think we still have some bit of downside pressure that we're likely to see from even these levels of around 17,700. Getting to stocks that are in focus, Aegis Logistics, that came out with a set of numbers. Looked quite good. That stock is up 7%. You have Apollo Tyres as well that came out with a set of numbers, and that one as well opened up with a gain of around 1% odd, but that's petering down a little bit. Birla Soft is getting a hard knock now as we speak, and the Ambuja Cements, ACCs of the world, yesterday in fact we saw a bit of recovery, but the Adani group of stocks yet again, they have come in for a bit of a knock, and some of these metal stocks as well, like Vedanta has pulled back a little bit as we speak. Prashant.
So 70 points, Nigel, now, right? We're at 17,680 as we stand right now. Too early to make any conclusion based on the breadth of the market, but it's close. I mean, you've got about 1,000 stocks which are higher and about 800 stocks which are lower. So it's close. I mean, it's not runaway or anything in either direction. And that is not bad news. Adani Ports is the one that I'm watching. It's now down to the lowest point of the day. And yesterday's low, by the way, was what, 424? We're at about 438. So it's not very far away from the day's low on Adani Ports.
Prashant, just one more point. In the month of February, normally towards the end, you have the NSE revision that takes place on the number of Nifty stocks that come in and move out, which will be effective from the end of March. The date normally is 31st of January, and we've seen a fair bit of volatility. So I'll be tracking this change, this revision in indices rather closely, because of the way both these two stocks have underperformed. So let's see whether or not there is a change that comes about. They'll go according to the last 6 months free float, but let's see what happens to both these two because they're part of the index.
No, there'll be absolutely two of them, of course, part of the Nifty index.
Yes.
We'll see in terms of changes. Atul Suri is with us. He's CEO at Marathon Trends PMS, and he's joining us from our studios here. Atul, great to have you with us here. Thanks very much.
Nice to be here.
We've been, of course, fixated and naturally and correctly so on what's happening here, but this global scene is turning out to be pretty good. I mean, has something changed? Because, or is this still a bear market rally, as many are saying
No,
it is? What's your sense?
I get a sense that actually we are starting a big global move up in equities. See, the last year has been a washout. In India, though, optically at an index level, we've been flat. But if you look at global markets, like you're talking about 30% knocks in US indexes, which is a lot, which is massive, right? So India, fortunately, has been insulated. But these markets are actually doing a very big catch-up. You're actually seeing that, what do you call a short covering bounce, that kind of momentum you're seeing. And the spaces that are beaten the most are actually seeing the biggest spring, like let's say the NASDAQ, for that point of view. So what you are really seeing is a very big bounce back globally. But I think this will actually move on to gain more strength. Like if I look at the US indices, if you look at something like, we look at something like the NASDAQ or the S&P 500, but you look at the Dow Jones Industrial Average, you'll realize that that is something that was the early breakout. You look at the mid-cap space, the small-cap space in the US, you see that there is very good breadth. And that gives me a sense that I feel that there will be a fresh up move in the US. A lot of these indexes, they'll take time. It's not going to happen in the next few weeks, but they will recover their earlier highs, which I think will be phenomenal for global equities. So I think there is a very big move. It's not just US. You look at the European markets. In fact, they have been more impressive in the last few months than even the US. So what you are really seeing is a global synchronized move in equities. In India, we feel bad about it, but hey, you know what? You just can't take a 1 month or 3 month view. Let's take a 2-year view. I think we are still one of the best performing markets in the world.
But Atul, the point is that...
to that view that we're starting something, a big global equity bull market, you don't think central banks will come again and smack it down? When you're in the midst of sharp pullbacks, it's just a question which I have to ask. Maybe, and I tend to lean towards your view, but anything is possible. It's markets, right?
Absolutely.
In the midst of ferocious big bear market rallies, always feel like it's the start of something new. It's probabilities game at the end of the day.
Definitely. See, at the end of the day, Prashant, nobody knows the future. We can't predict tomorrow. Look what happened last week. We were at 18,200 Nifty and we felt like with a good budget, 3 days ago, I think in the budget, the first half, we felt, well, it's all over, done and dusted, and see what happens. Anyway, that apart, we're talking about central banks, I think you should look at bond yields. Because the governors are saying one thing, they are continuing to sound hawkish, but you'll find where the bond markets are. You look at the US 10-year, I think that's a very good indicator of market sentiment. I mean, that is below 3.5. That is, I think, 3.4 or below that also. So I feel that if US bond yields remain below 3.5, which if you look at the charts, etc., you'll find that there is a great propensity for it to go lower. If that happens, look at the way the dollar is behaving. So, these are very big asset classes. These asset classes like bonds and dollars are not a function of one quarterly earning or sentiment. These are giants. These are the elephants in the room. So if you really look at them, I think that is what gives me more bullishness than just what Meta does for 2 days and like people get bullish.
Take your point completely, Atul. But okay, here's the question. The fact is that we've been disconnected, right? And who better than you to ask this? I know it's only 1 month and we shouldn't get carried away with one January performance and our underperformance. But if you go back and look at, periods in the past where India has been sort of, dislocated with a global tidal wave of equities rising higher, what do those periods tell us? And could this be such a period again, a long period of a disconnect?
See, so it's again a question of time frame, right? If 1 month they say, oh, India has not done well. Hey, how about taking it 2 years?
No,
I'm just giving you...
I'm just worried that, will it be just 1 month? Could it be 6 months? Could it be a 1 year disconnect?
It could be. Who cares? But the fact is, let me tell you, if you overlay charts, see, as an investor, you're not looking at 1 month and 3 months. So I'm speaking from an investor's point of view. If you overlay charts of country on country on country and country, you'll find that there's a sync to it. In every rally, there will be something that will outperform. There will be something that will underperform. But net, the bigger picture, when the globe
Moves up.
It's a question of money moving, and we are a globalized economy. That's why I think what I spoke to Prashant about bond yields, about currency, they give you bigger clues of flows of funds. Yeah, sometimes now people are getting, oh, China is a great
China's
place.
getting the money.
But that's nonsense. You know, if you go back and look at markets 2 years, 1 year from that point of view, where would you be in a China or a India? So it's very nice and cute to talk from an Excel spreadsheet or at a cocktail circuit that, you know what, boss, the best investment last few months would have been to buy the ARK fund. Hey, you know what? ARK fund has come from 140 to something like, 140 to something like 20 or 30 bucks. From 30, it's gone to 45. So it's very nice to talk about it.
Yeah.
You know, so these things are very good. They're good numbers or statistics. And even in statistics, what is the time frame you use? The moment you change the time frame, the story changes. So I have to understand what is my time frame. If it's 3 years or 2 years, you'll find that India is the best performing market. We have fallen the least. And we were the first markets to break out to lifetime highs.
Yeah.
We were the first market to break out a line. If we are taking a pause and we are letting the world catch up, and you have a very big Adani saga, if that also gets out of the system and the markets continue to make this thing, I think that really shows the quality and strength of the market.
Yeah, right now, Nigel, stocks are not responding at all. I mean, Adani Ports is down 9%. And across the board, there is still selling pressure. Ambuja, ACC, we were talking about the clarification, 3%, 3.5%, even in the cement assets.
Yeah, I'll tell you what, the bigger problem is the bullets are gradually leaving the gun, and they're not having that big an impact. So I'm a little worried on that front as well, because you have ASM, you expect some bit of stability. That's not happened. Yesterday, you thought maybe there'll be some naked shots in the system, but let's keep this saga aside for the time being. Well, Atul, talking about the cocktail parties has become easier, right, to go, because then everyone's not giving you all sort of gyan or advising you now with the markets a little bit brittle. That aside, you said pockets of strength will still be there, right, in the Indian markets. And in the past, we've spoken about defense, we've spoken about the PSU banking theme. Some of these themes have corrected. Is it giving you a good entry opportunity? And what's the theme that you think is looking good now?
No, I think speaking about PSU banks and banks, it's very important. It's the most important sector as far as the index movement goes. Now, you have an Adani issue, which we all know about. See, nobody had a clue as to what was happening, and nobody knows how it's going to end. Yes, it becomes excitement, 10% up, 10% down, all that. But I feel it's fairly insulated. The important part is that how many funds own it, because that's what's going to affect. How many retail investors own it? Very few. Those who own the derivatives market have got cleaned out because their margins have got wiped out. So net, the question is how much collateral damage is it going to create? The collateral damage it can create is in banks, because obviously they have lent to it. But in spite of an event like that happening, if banks pull up and are able to recover, in spite of such an event, I think that will show intrinsic strength. And these become, opportunities to buy. So I feel that the whole Adani issue, yes, it's an important thing, but if it remains insulated and there is no major collateral damage, and we are seeing that in the markets in the last 3-4 days, that there are still sectors and stocks making new highs. It's not overall across the board. In fact, I think a lot of people are using these opportunities to get into other spaces.
Atul, as you speak, in fact, the Nifty bank that took a harder knock, that's seeing a good bit of recovery. We're up close to around 500 points out there. And I think SBI's numbers today will be very, very important because of the commentary. Results aside, the commentary will be rather important. But this entire China theme is playing out. One way to play it from an India perspective is the metal theme, the metal stocks as well. And they have done phenomenally well, actually. Do you believe commodities still have more room on the upside?
Yeah, I think that's very interesting because, I was one who believed that the commodity story was over. It did very well in early 2022 and then it corrected and I thought it's over. But a lot of them have come back. Like I look at copper because I think copper is a very good windmill towards the whole commodity move. I find that commodities have made a recovery and that whole thing that commodities would really tank out is not really happening. In fact, even if they remain stable and a little on an upward bias, I feel that a lot of these metal stocks, and not just the 3 or 4, there are a lot of other derivatives to it, are looking very, very interesting.
From a positional perspective, give us 5 ideas.
Oh, 5.
5 ideas.
No, not 1, not 2, but 5.
I didn't say 5 stocks.
Let's take
He's
10,
saying
let's take
ideas.
20.
You want to give us 10? 10? Go ahead.
No.
Or 3, whatever. Where are you most convinced about, setup-wise?
Yeah, sure, Prasad. So I think the question that comes up is that thematically, I feel, so I have been bullish on the market and I still retain that bullishness. But I think the bigger money as we are positioned is we feel that there is a very big shift that is happening thematically. Like I talked about the US. So let's start right from the top. You find that the Dow Jones Industrial has done much better than the NASDAQ or the S&P 500. So really you find that the industry-facing stocks, even if you look at new 52-week highs or lifetime highs happening in the US, they're more in the industrial space. So industry-facing stocks are doing much better globally. Even if you look at the Indian markets, you will find that whether it's banking, the industry-facing banks, you'll find things like capital goods, things like infrastructure. These are doing very well, engineering. And for a decade, you will remember that we have been dominated, or the other side has moved. You know, what we call the high P stocks, stocks that did well even whatever the economy was doing, they were captive consumption. But I think the whole market is telling me, or indicating to me, that we are moving towards a revival.
Banks, capital goods, engineering.
I think engineering, and even in engineering and cap goods, there are a lot of sub-segments. Like I think the electrical equipment plays. There are few of them, but I think they are like an absolute different story that is happening out. So I feel that we will have to recalibrate. There will have to be a churn in the portfolio, and we've been doing that. And we see ourselves more oriented towards the industry facing, because whenever an industrial cycle or a cycle turns, then the bull markets are not short because they're not liquidity driven. These tend to be 3 to 5 years, and then the kind of money that you make is massive. So I feel that the globe is moving back to industry, moving back to manufacturing, rather than just pure services or the leverage trade.
So Atul, just one final question before we let you go. We've got the big macro picture. Just the here and now, you made a point on Adani and related issues. You said everybody in the F&O market has anyway been cleaned out. Just want to get your sense on these new additional surveillance mechanisms that have come into place. And maybe we don't know if more stocks get added or not.
Sure.
Purely from a leverage and market perspective, if the authorities and regulators decide to take more stringent just surveillance norms, is there going to be a domino effect in the market on other Adani stocks or other stocks, just on the technicals?
See, I'll tell you, as far as Adani stocks, where they will stop, what will happen, we don't know. Look at like that day's FPO getting cancelled. I mean, even an hour before, if somebody told us, you'd laugh at their face, right? So the fact is, we really don't know, because we didn't even know before, we don't even know now. And the good part, as I said, is that fortunately, we never bought Adani stocks, and most never bought it. The problem is collateral damage. As long as there's no collateral damage, they will do their story. They will keep you guys excited and keep you guys busy.
That's what I was asking. As long as the rest of the market is kind of
as long as the rest of the market, and even in there,
and you believe that's the case?
Yeah, and look at, I think for me, there the litmus test is banking. For me, the litmus test is banking, because ultimately they have a bit of an exposure. If that holds out, that recovers, that gets bought into and takes out new levels, this thing is done and dusted with. And we have to live with that story here.
And we need less excitement, not more excitement.
I know, you guys are having busy times here.
Really less wired, not more.
Yeah, I can
Thank you very
imagine.
much, Atul. It's a pleasure.
Thanks, guys.
Joining
Thanks
with that perspective. I want to just quickly point out what's happening with Adani Enterprises. It's now down 15. The damage is 3 days. Today is Friday. On Wednesday, it was at 3,000 rupees. From 3,000 to 1,300. I mean, that's the brutality of the fall, and that's markets for you. Just complete damage. I mean, incredible. Ports is down, of course, 8%, 427. 3 days back, it was closer to 650. It's under 450 odd rupees now. Well, the market is not looking all that bad. The rest of the market, that is, it is starting to differentiate and kind of starting to move on, as we've been hoping and pointing out as well. 64 points on the Nifty.
Prashant, just one more point. The Adani Group's total market capitalization since the time of Hindenburg's report coming out, it's halved. Effective today's fall. I just look at a data point on the Bloomberg, and it did state that. So that's the kind of pain. Talk about few sessions, 7 sessions, and the group's
I think this is Jan 24 onwards. I think you take the fall and then you're talking about a 50% decline in market capitalization. That's been the brutality of this.
7 sessions odd. So.
Yeah. A lot can happen, I guess, in 7 sessions. All right, but for the time being, we're going to move on and get a couple of corporate conversations going. Max Healthcare came out with numbers, and it was a good third quarter for the company. Revenue is up 12%. Margins also expanded to around 28%. Furthermore, the average revenue per occupied bed has improved for the company. But there is a marginal dip in occupancy, perhaps due to the festive season. Abhay Soy, Chairman and Managing Director at Max Healthcare, is with us. Abhay, good morning. Great to have you on the show. So just take us through some of the, the more granular trends, the slight dip in occupancy. Is this usual seasonality? And more importantly, what are the trends that you're now seeing, in the fourth quarter, especially with respect to things like medical tourism, Just some of the headline trends that you're noticing that impact the top line.
Thank you so much for having me. Yeah, so if I look at Q3 versus Q2, the second quarter typically is a quarter where you have seasonal diseases like dengue, other viral waterborne diseases, etc. So typically, the second quarter itself is characterized by higher than normal occupancies, and that's something we had even guided to last quarter, and you see that happening year on year. And the final quarter, the third quarter in any case is a holiday season. It's New Year's and Christmas, and that's time a lot of the surgeries, etc., get deferred. So typically it has a lower sort of occupancy compared to, again, then sequentially, if you look at the fourth quarter, typically it's a higher occupancy quarter with higher RPOBs and you're back to normal. So typically, previously as well, year on year, you'll see the third quarter as the weaker quarter as far as both occupancy and RPOBs are concerned. But I'm happy to sort of showcase that we've had the best EBITDA and a higher RPOB as well, like you rightly pointed out. Now, when it comes to medical tourism, I think we are already back to 110% of pre-COVID levels. I mean, of course, much higher than last year, but then last year was impacted by COVID. So even compared to pre-COVID levels, we are beyond 110% of pre-COVID levels. This is in spite of, this is something which is very specific to Max, that 12% of our business used to come from Afghanistan. And because of the geopolitical reasons, because the government has sort of suspended visas over there, that business is down to not at present. And we're hoping in the next few quarters that'll bounce back again. But that should take us to even further numbers. Coupled with the Heal in India, Heal by India, push impetus provided by the government, I think it is going to augur very well for global medical and international medical tourism for Indian healthcare chains.
Right. Could you provide us, Abhay, good morning, with some guidance on what the contribution share would? I think we've spoken about this in the past, but given that you're already, as you said, the 110% of what you were doing pre-COVID on the international patient front, where do you want to take that up as a percentage of the business? Because that is also highly profitable for you.
No, absolutely. And I think if we get our story right as a country, as an industry, I think, it's not very difficult to sell healthcare from India simply because, the huge value that Indian healthcare provides compared to an intrinsic value compared to anywhere else in the world, both in terms of skill sets as well as remarkably lower price points. We are the cheapest sort of healthcare providers in the world by a significant margin. I think we are now getting the India story right, putting India as a safe destination. I think the government is putting up the websites where, they would be credentialing hospitals and so on and so forth. Right now, we haven't even scratched the surface as far as global medical tourism is concerned. I think, there can be an exponential increase. Like you rightly pointed out, it is a high contribution and a high RPOB business as well, simply because anybody traveling to India for medical tourism is coming for more fatal diseases, is coming for higher end quaternary care. So, average billing is much higher. So I think, once we get our act together, there can be an exponential increase in this business. Coupled with the fact that we are coming up with immense capacity over the next 3 to 4 years, I think in terms of percentage, it can go far higher. But again, we're also seeing a massive ramp up in other businesses as well.
Okay, Abhay, you kind of brought me to exactly my next question. And I think what Prashant asked, as a percentage of the revenue pie, where will medical tourism be? And what about Max at Home, the home care business as well as diagnostics? We're just trying to understand, let's say, if you're talking about FY24 and FY24, then how will the revenue pie look like?
So look, I think, we've stayed away from any sort of guidance as far as revenue and revenue pies are concerned in the past as well. So I'm going to avoid that question or duck it purposely. Max at Home is essentially home care business. What it means is providing a hospital at your doorsteps. So this is for long stay patients. We do dialysis at home. We do physiotherapy at home. We even set up intensive care units at home. And the usual providing nurses and doctors at home as well. This is an urban business. We are seeing huge traction in this. You've seen quarter on quarter and year on year increase as far as home care is concerned. Unfortunately, at present, it's not covered by insurance. And I think as and when it is, you'll see a major sort of drive in this business as well. Yet, I think organically, it's been growing at a very, very fast clip for us. When it comes to the laboratory business, I keep referring to this old advertisement by MRF, which used to be, the tires we race are the tires you buy. So our labs is something that all our 4,800 senior clinicians rely on. That is what we do in-house. The efficacy and efficiency of our labs, which are operational 24/7 within the hospitals, is right up there. And that is exactly what we take now in retail to people at home. And that's really our max retail business. So when it comes to specialized tests and so on and so forth, the perception of having done it in hospitals, and given that the fact Max has an immense brand, we have huge traction over there. So you'll see, as far as even non-COVID is concerned, whether it's on a year-on-year basis or a quarter-on-quarter basis, we've been gaining market share.
All right, Abhay, it's a pleasure. Thank you very much for joining us and running us through all of that. Good luck to you. Now, Titan is the next company that we are speaking with. The revenues for Titan are up 14%, but there is a miss on the margin front. Third quarter EBITDA is also lower due to a 200 basis point compression in the jewelry segment. Mr. Ashok Sonthalia is Chief Financial Officer at Titan, and he's joining us right now to take some questions. Mr. Sonthalia, thank you very much. The last time we spoke, bulk of the discussion was on two things. One was whether there is generally some slowdown that you're seeing at the lower end. And the second was on competitive intensity, margins, etc. How would you characterize the growth that you've seen in the context of both those elements?
So, good morning and thank you, Prashant. Quarter three started very well with the festive season. The October month did extremely well. And it is typically after that season ends, some slowdown do happen. And this time also with the rising gold price, we saw some, I would say, demand volatility, people sometime holding up. But overall, 15% retail sales growth in quarter three is quite satisfying to my mind. And we are happy with that performance.
Mr. Sonthalia, good morning. So when you say that there was some slowdown in demand, is it a function of perhaps higher gold prices, as you said, and has that continued to impact the January-February quarter as well? Because gold prices were peaking even in January. So is it gold prices that's keeping people away, or is it also competition? I mean, is there any hint that perhaps there's some sort of fight for market share?
No, I think as far as competition is concerned, we continue to kind of gain market share. So that concern is not there. Of course, we also kind of remained pretty competitive through our offers, through our marketing campaigns, new collections, etc., throughout the quarter three. So competition is not worry for our slowdown. It was generally consumer sentiment because of a higher gold prices. But in the month of January, we say people have now taken that in stride, that the gold prices are higher, may expect to be further higher. So now they are coming back and kind of concluding their purchases for whatever necessity they have, wedding included in that.
Said that,
has been good.
Okay, got that, sir, got that. You said that you're actually gaining market share and that competition isn't a concern right now. Can you quantify that? How much is the market share gain?
It's slightly difficult, but now we believe for the entire industry, we have inched towards 7%. Maybe sometime back, year or 2 years back, we were around 6%. The indication how we get is that new market share in our buyer growth, about 49% this quarter compared to 48% of the last quarter. So we continue to see traction of getting new customers to our jewelry segment. And that gives us confidence that all these new customers, part of it definitely coming from competition to us.
All right. Hi, good morning, Mr. Sonthalia. This is Nigel on this side. In the past, you've mentioned that you want to take that market share to double digits, which effectively would be around 10%. Do you see it happening sooner than 2027 that was initially laid out as a target? And also your studded part of your business, studded share, it was at around 26%. Whenever you've been joining us, you've been telling us that maybe that number heads up. what should be the rough band that you're looking at in terms of a contribution from that part?
So FY27, the growth ambition which we have put out, and we think it is reasonably in our reach to kind of achieve that. And typical industry long-term growth, if you bake that we believe by FY27 our market share should be 10%. But you know, like a lot of variables there, but that's the ambition, that's the estimate, we should be there. As far as studded share going beyond whatever it is right now, we are definitely leading diamond jewelry player in the country. And we believe diamond jewelry penetration in India is still at a low level and should be improving. And then we should able to kind of, and we as a player has a role in kind of improving that diamond penetration in the country. And through that, I think it should inch up. But while other categories are also growing pretty well for us, so sometimes these numbers become outcomes. So in absolute value, studded is of course growing, but in 3-4 years horizon, I definitely think that studded can inch up from its current contribution to our revenue.
So Soundarya, could you give us a number from this mid-20s? Do we see it go to 30s? So we do mid-30s? I mean, what should the outlook be? And the budget also announced some incentives for lab-grown diamonds. Will this impact real diamonds?
So if you are aware, 1 year back, we invested in a US lab-grown diamond jewelry company. We picked up a minority stake. We see that, and US is the most exciting market at this point of time for the lab-grown diamond jewelry. And that is where we wanted a ringside view of what's development happening in the US market, how consumer is approaching lab-grown diamond, etc., etc. I think in India also it will start making entry, but we say not as a substitute to natural diamond to begin with. 5 to 10 years, there could be some traction, and we will be ready to play that game because we have made this investment and our understanding of lab-grown diamond is pretty good at this point.
And studded business, sir, you didn't give us the number.
I think it should go towards 30%. I would not expect it to.
By when?
Very difficult to say, Nigel, but yeah, it should inch up, and that's our desire also, because in any case, profit-wise, it's a slightly better profitability compared to gold jewelry.
And I like the characterization of diamonds, right? It's lab-grown diamonds, not versus real, versus natural. Because diamond is a diamond.
Both of you gentlemen, may I just offer some unsolicited advice? Anniversaries, birthdays, might want to stick to natural stuff.
When there's only limited you have, there's only limited you can spend. So,
but Mr. Santalia, so when we spoke in November, you had said that across your categories, on the entry level, things are going poorly, and you said that you expect a slowdown for 2 to 3 quarters. Can you tell us if that is still the case? Has that intensified, gotten better?
No, so that is still the case, Prashant. We see the entry level consumers are still finding it difficult on spending on the discretionary. I think that's the most affected category and the consumer set from the current inflationary environment, high interest rate environment where EMIs are going up, etc., etc. So we continue to see that pain into our entry-level watches, our entry-level jewelry. Their growth rate are not what the premium segment is witnessing. And I do expect that to continue, as I said last time, to 3 more quarters.
Mr. Santalia, just a word on the margins as well. They have dipped across segments. I mean, the dip is more pronounced in jewelry, even in eyewear. I mean, there is a dip. I'm talking about year on year. Even watches, there is a minor 50 basis points shaved off. Do you see this as a trend, or do you think you can make up in Q4 and beyond? And again, at the headline level, what's the margin outlook that you have at a blended level?
So we always maintained this, when we were even delivering higher margins, sometimes there were one-off items helping us. In last quarter 3 also, we called out that 1% was one-off item in the Q3 of last financial year. So from that perspective, margins have not taken a significant drop. We have been talking about 12 to 13% margin. with a industry leading growth rate. And that's the operating philosophy. When the demand is good, environment is good, we want to chase growth at the stable margin, which is 12 to 13%, we believe is a good margin to target for.
All right, Mr. Zandali, we'll leave it there. Good luck to you, and thank you so much for having the conversation with us on the back of the earnings. Thank you indeed. Adani Enterprises is now down 20%. So that is a sharp cut once again on the holding company. So 1,252 on Adani Enterprises. Adani Ports is down, still down under pressure. 7, Ambuja and ACC are down 3 and 2.5% respectively. There's no change. Most of the stocks are still at their respective daily circuit levels. We'll take a break. We have Dr. Om Manchanda, Managing Director at Dr. Lal Path Labs, joining in to discuss their numbers for the third quarter. Stay with us.